Hello, everybody. Hello, hello, hello. And happy Monday. Yes, you can see I am not on the floor today. I will be later in the week, but that is okay. Hope everybody is doing well. Hope you all had a fantastic weekend. All right, Brad, Steve, everybody's in here early today. All right. Well, what can we say about this market? Teflon, I mean, volume is not great, but man, oh man, we just keep pushing higher and higher and higher, and pretty surprising to me. But here we are. We'll keep an eye. I'll keep an eye on for everybody also in Palo Alto here, guys. For those of you that maybe don't have a couple monitors or whatever, Palo Alto, our second partial exit in the option volatility room, is getting pretty close. Really good start to the Monday again today, guys. GLD, Palo Alto, got an Octa roll off. So it's all good. And yes, I am sporting my Baby Blues weekend Cubs jersey because I am going to the Cubs game tonight. So wish us luck. We play the Royals. Unbelievably as good as we're playing, the Brewers have won 10 straight and are now tied with us. So that is a little hard to swallow right now, but I will be at Wrigley tonight. All right, everybody, let's get into today. Let's talk. Well, first, yes, thank you, everybody. Smash, smash, smash away. Subscribe, smash everything. Let's go. Let's go. Let's go. All right, Today we are talking about getting married. We are talking about getting married. Maybe. Okay? Don't want to get into anyone's personal lives, but if you're going to trade, we need to know what married puts are. All right? We need to know what married puts are. How many of you have ever used this strategy? How many of you know or understand what this strategy is? Here comes the bride. Never heard of it. Good. All right. Good. And this should be a good one today because especially, you know what, I don't want to spoil it. I'm going to go through some remarks on it here, but let's go through it. Okay? This is what a married put is. It's a strategy that's used as a hedge against a temporary dip in the stock's value. Now, why do I say temporary dip? Because it's a strategy to use in addition to owning a long stock position. So, maybe you own, I don't know, Nvidia from $70 ago, which was just 6 weeks ago, or whatever it is. The reason it's a temporary dip is because if you were really bearish on that long stock, if you didn't like the company anymore, you would just sell the stock, right? So what happens is if you have the long stock position and you buy a put against that, you still have upside potential, profit potential with the stock. You limit the downside risk. So when would you consider this situation? When would you consider using it? Well, now is a pretty good time. Now is a pretty good time. The market has run so far, so quickly. Volatility is low, right? You always want to try and put this type of position on when volatility is low because you're going to be able to buy your put cheaper than normal. So now's a really good time. You could also use it before an imminent news announcement, maybe like earnings or something else. Okay? When it's vital to ensure the value of a specific stock for a certain period of time. Okay? So if you're holding stock and you know that 3 months, 6 months, a year, whatever it is down the road, you need that money and you want to lock it in or at least protect it, great. Use a married put. Okay. If in your portfolio one stock maybe is outsized a little bit and you want to give a little hedge against it, good time to use it. Okay. Now, some people, some people, if they own stock, if it's within their own company that maybe they work for, or if you happen to be on an IPO and your stock is restricted, meaning you have a set time period that you are not allowed to sell that stock, you buy a put to hedge that downside. Okay. And also, you can do that to protect substantial unrealized gains. Okay. These are some times when using this strategy would be really, really fortuitous. Okay. We've gone into the collar strategy before, where we've talked about buying a put and selling a call, right, to hedge a position. But what that does is really lock in your profits and limits any upside because of that call sell. Here, sure, you are paying for insurance. You are paying for insurance, but your upside still remains. So we'll go into some live examples here. Okay. Now, you may have heard, and actually it's in my verbiage right here. You may have heard the terminology protective put. Is a married put the same as a protected put? What do you guys think? All right, get some more answers here. There is a slight difference. They both accomplish the same thing, but there is a slight difference. Okay. Good. I love the engagement here. The mistress, no, Kevin, it's not a mistress. And given what went viral last week with that Coldplay concert, I don't know that we want to go into that situation there. I don't think we want to talk about that. Okay, well, let's take a look here. Typically, typically when we look at buying that put, that protective or married put, we usually look at the money options or just slightly out of the money. And the reason for that is that gives you, as it says here, a balance between the premium you're going to pay, which is why it's always good to look at this, especially when volatility is low. Okay. So it's a balance between the premium you pay and where that protection sets in, right? Obviously, the further out of the money you go, the less it's going to cost you, but your protection is also further away. So far out of the money puts may fail to give you that protection that you really want. Okay. So obviously, the higher the put strike, the more protection you're going to have, the more it's going to cost you. Okay. Does that make sense to everybody? So the difference between the two is that a married put, you're putting a position on at one time. You're buying stock and you're buying a put at the same time with that strategy in mind of having that protection. A protected put means you're adding the put to your long stock position at some time down the road. So you ultimately wind up with a similar position, similar P&L outcome, but it's just a matter of the timing of when that protection is purchased. Does that make sense to everybody? That is the only difference. That is the only difference. And what are your options? Trading debt. Yeah, you need to strike that balance. And really, there's no right or wrong. Striking that balance is really um, individualized for any position, for your own risk tolerance. Okay, maybe you want a little bit more protection. You go at the money, maybe a little bit in the money. Maybe you're not as worried, still want a little protection. You don't want it to cost as much, so you go a little bit further out of the money. Okay, but in general, this is what, if you have that position on, this is what your P&L graph would look like. Okay, so in here, the dots right here, that would be your stock only. Long stock position, obviously, unlimited profit potential, unlimited loss potential down to zero. If you only had a put, if you had only bought a put, that's this brown dash line here. The reason this is straight across here is because that's the premium you pay. That's all you can lose. And then obviously your upside is the further and further and further the stock goes down. And then this blue line, that blue line, let me erase everything and just kind of circle that. This shows you that you keep your upside and you limit your downside. Now, your upside potential will be hit a little bit. It will be a little bit less than just holding the stock because you have to consider the premium that you paid for the put. Okay. Stephen, when you say what is it, what are you asking? What is it? Come on, Palo Alto. We are a biscuit away. A biscuit away. Stephen, what are you asking? A banana? Well, I guess some would say that. Some would say that. But does this graph here, and this is just a generalized graph, does that make sense to everyone? Okay. And we'll go through a live example here. Okay. So let's talk about P&L. Okay. Your maximum loss is limited. Okay. Your loss is limited to the amount you pay for your put and how much lower that put strike is from where the stock is. So let's say you have stock at 150. Okay, that's your basis. Stock's trading 160, so you're already up $10 on your stock, and you purchased the 145 strike put. Okay, well, sure, you can, if the stock comes down, you can lose a little bit there. But that 145 put plus what you paid for it, that will be your floor, or that will be your stop out price. But like this says here, obviously your potential loss depends on how much you paid for your stock when you first bought it and how much the put is. Your maximum gain still is unlimited. Your maximum gain still is unlimited. Does everybody understand why that is? And we can go back to this graph here, does everybody understand why your potential upside is still unlimited? Okay, lots of yeses. I'm just gonna, if there's no no's, I'm not gonna go into it. Yes, the loss on the put is limited, Kevin. That is exactly right. You can only lose what you pay on the put, and the stock can go up forever. You know what? So before we go on any further, let's get Thor's word of the day here. Exactly right, Kevin. Vows, wedding vows, married, married, married. That is our word of the day today. Give that another minute or so. Palo Alto stock is now trading on its high of the day. I know we're not quite filled yet. Boy, oh boy, what a run this thing is making here. All right, Thor, we'll come back to you later. Okay. So again, potential gains unlimited. Okay. Now, is the married put, or call it a protected put, because ultimately it winds up being the same position. There you go, Kevin. Boy, it's almost like you saw this presentation ahead of time. Harris, the word is not married. The word is not married. We're not letting you in with married. There you go. Thank you, sir. Okay. Everybody remember our conversations about put call parity and synthetic options? We've discussed that numerous times. By the way, what does everybody think of this Cubs jersey that they wear at home on the weekends? It's the new baby blue. And I'll show you. Mine is actually, I don't know if you can see, mine has my SIB acronym on it. 9 is my favorite number, which is why I have 9 on there. But out of all the alternate jerseys that Cubs have ever had, I think this might be one of my favorites. Cubs are tied for first place, Steven, yes. Taking 2 of 3 from the Red Sox this weekend, and the Brewers wound up sweeping the Dodgers again. Who would have thunk it? Yes. 10 in a row, Steven. Don't remind me. Don't remind me. And the Cubs play the Brewers later next week up in Milwaukee. I am definitely going to be going to one of those games. So anyway, if you remember back to our conversations about put call parity, synthetic options, okay, are they the same? Is a married put the same as an uncovered call? And Lita, that's a really good question. Why would you use a married put instead of a stop? Well, if I have a stock position, okay, and again, if we go back to this right here, we're referring to a stock position you have that you're, probably going to hold for a while. If it was not something you wanted to have for a while, you would just use a stop and you would just exit the stock. But the protective put allows you to still stay in the stock position. Rather than just stopping out and getting rid of the stock. Okay, so are they the same? Elisa says they are not the same. Anybody else? George, no. Okay, Elisa, Brad, no. Okay. Elisa, you were the first one to answer. Kevin, no. Elisa, you were the first one to answer. Give me a stock you would like to look at. Any stock. We're just going to use it for an example. So remember, on a pullback, what are your options? On a pullback, you're not actually pulling in extra money because you're paying for a put. CRM it is. Let's look at both positions and take a look. Okay, so CRM. Okay, let's just go out to August here. Okay, let's say you own the stock is 263. So let's say you own the stock and you also own the 250 put. Okay. The 250 put has a delta of 29. What would the delta of your entire position be? So long 100 shares of stock and long one 250 put. You would have a delta of 71. Wonderful. Now, if we had this position, 250 put, and because I can't add stock in here, I'm just going to add in a deep in the money call, which is the same as stock. You will see this position. Okay, so what do you have here on this position? You have unlimited upside. Okay, unlimited upside, and your downside is stopped out right there. Okay, now let's take a look at just the 250 call. Okay. Look at that. You have the unlimited upside. You are stopped out at what you pay for your option. P&L is going to be almost identical. So putting on a married put, not a protected put, that would be a little bit different because we don't know the cost basis on the protected put. But putting on a married put, which means buying stock and buying put at the same time, that is the same as owning a long call at the same strike. I am looking right now, I want to bring up something from our discussion on synthetics and put call parity. So just give me 1 second as I look at it. Okay, put call parity. Here we go. Okay. Remember this? Remember the equation? If you were to put this into that is correct, Gene. If you were to put this into a synthetic algebraic equation, that is what, whoopsie, that is what you would get. Now, I know I have another. Here we go. This is what I actually want to show. This was from part 2 of our put call parity discussion. So everybody remember this chart? Here is your married put or protective put. Is the same thing as owning a long call. There are a few differences, like Gene just said about a dividend, but that position is the same. Does everybody understand that? So again, I think what you want to kind of take out of this discussion today would be this. It's a hedge against a temporary dip in the stock. Otherwise, again, as Lita said, you would just use a stop order on your stock and just sell your stock. Okay? The best time to do this is when volatility is low. So, going into earnings, people say, what can I do here to protect my position? Well, you could certainly sell a covered call. You're going to get a lot of premium for it, but then your upside becomes limited. And if you buy a protective put, you're paying a lot more for it. So the best time to do this is when volatility is low. Does everybody understand that? Does that make sense? Awesome. All right. We got the wheel ready for today. I'd say it's an average sized wheel today. I'm not impressed. I wish there was more to it. But it is what it is. The show must go on. So let's give it a whirl here. Here we go. John, Justin, Kevin Wally, Kevin 9319. I am not sure that I have seen. Thank you, Aladdin. Well, Lita, that's one reason. Kevin 9319. That was quick. You were waiting. You were just waiting. Awesome. Awesome. He is here. There you go. Send me an email to prosperswag@prospertrading.com. Love that. Love that. And yes, Lita, besides the wash rule, okay, how do you know you're able to buy it back? What if you get stopped out and then flies, right? Because remember, a lot of times that happens with stops. When you have a stop out there and the rest of the world, traders see that stop kind of as a focal point there. Sometimes that's not the best thing to use. Plus, what happens, Lita, in the case of a big gap, right? Let's say you have a position, a stock position going into earnings, right? So CRM was what, 263. Let's say you have a stop in at, I don't know, 255. Okay. Earnings come out and the stock opens at 220. That's where you're going to get stopped out. As opposed to having the protected put situation, sure, it's insurance. You have to look at it as insurance. We have to pay for insurance. When do we want to pay for insurance? When we don't need it, when it's cheapest, when volatility is low. Lita, does that make sense to you? Awesome. Awesome. It was a great question. All right, everybody. Smash away, smash away, smash away. If you're watching the Cubs game tonight, I'll be sitting kind of right between home plate and the Cubs dugout, just a few rows back. I'll be in this jersey. I will be there with my wife. There will not be any sort of kiss cam like at Coldplay, or if there is, at least I'll be with my wife. What a story that was. Oh my God. Oh my God. Kevin, that was quick. Nice. Steve Bartman approved. Trust me, I will not be interfering with Moise Alou trying to catch a foul ball. All right, everybody. Great start to the week. We're going to start getting, it's still summer, but we're really now in the heart of earnings season. And this week starts the mega caps, some of the Mag 7 stocks. So we're really going to, see some market moves, I would think, based on how these mega caps are coming out with their earnings. This week is not like last week in terms of eco data. Last week it was like chock full of eco data. This week, not so much. Come on, Palo Alto is just teasing us. Here is our spread in Palo Alto. We're at 450. We've already sold some at $4. So we will see what happens. But in any event, hope you all have a wonderful, wonderful Monday. Go Cubbies. See y'all later.